All right, guys. I have it's an exciting day for me because it's like one of those things where they say on the internet you could just do stuff, right? So I was like, I've been seeing Tyler pump out a lot more content lately, and I love his stuff. And I have my take on Tyler is that he's like one of these very few people where he's like old and young at the same time, right? Where I feel like I kind of fall in this bucket too, where at times I feel like the worst boomer ever, and then I'll talk with my little cousin and I'll be like, "Bet high key that was like a good play," and I'm I'm mixing it up. So I reached out to Tyler and I was like, maybe he'll record a pod and see what we can do, and he was like nice enough to extend it out to one of these random accounts that messaged him. So I appreciate that. So welcome, Tyler. If people don't know you, why don't you just give the quick rundown on your illustrious career in finance up to now?
Yeah, I mean, I'll try to be quick, but generally, I fancy myself as a macro investor that dabbled into crypto somewhat early, and so I started out my career at Keefe Bruyette and Woods, which is a boutique investment bank that just covers financial companies, and this was in like 2007 when the financial crisis was unraveling. And so this bank, what I was doing was like imputing like non-performing assets on bank balance sheets, and we just saw them skyrocketing, and no one really knew what was going on. And this was, how much leverage was in the system. Is everyone on Wall Street at that time was watching, the world unravel, and they couldn't really say why. Besides, at Keefe Bruyette and Woods, they kind of get it because they knew the banking system inside and out. But everyone else on the street had no idea. And that gave me the vision that like the whole system is kind of a Ponzi scheme, and it's just based off of this like weird shadow banking thing. So I dug into that for years and years and years, and worked at a variety of different shops, hedge funds. I worked at a giant long only called Franklin Templeton for years. It's like $1 trillion asset manager, an activist fund, and then my whole thing is I'd rather have one experience, 20 experiences one time than one experience 20 times. So I've worked at a variety of different shops and learned a little bit, at these different spots. And I think that's given me a great view of like market structure and, being a macro investor in generally, and how the system actually works versus how we think it works, on the consensus side. So I don't know if you want to dive deeper on any of that stuff, but
Like how did you, like, you were probably pretty young at that time. Like how did you, like, what was running through your head when you realized like, oh, this is how the system works? And like
yeah.
like were you just not old enough and had enough capital to like capitalize on something like that if you were kind of around in that time period? Like, yeah, shouldn't you be
Mhm.
retired by now? Shouldn't you be a billionaire, Tyler? What's
I
going on?
wish. I wish. So yeah. So after Keefe Bruyette Woods, like I took this job at a hedge fund in Miami, and so I go down to Miami, and there's these giant buildings in this part of Miami called Brickell, and I ended up moving there, and there's sky rises like 40, 50 floors high, and just building was completely empty. And I was living there for like maybe I think it was like $600 a month, fully furnished, had my own pool on the roof deck. Like I was like a king at
Yeah.
20, 24, 25 years old living in Miami. And then, what I realized there was number one, all the banks were insolvent because like these buildings were empty and they lent gazillions of dollars. And then after that, they were auctioning off these apartments. It was like 25 grand a pop for these high rise building apartments overlooking the water, gorgeous places. Now they're all like $2 million
Yeah.
apartments. But I was dirt poor at the time, and just right out of school, so I had no capital. But it opened my eyes to like the money printing, because after 2009, what I call the acronym factory is like whenever the system's going to try to take care of itself by any means necessary.
Yeah.
And whether it's TARP, like these are they've gone down. You could have like pages and pages of acronyms they pull out. And every single time there's a hiccup in the credit markets, even to this day, they'll pull out another acronym and act like it's not just diluting the currency. So that's what inevitably led me to crypto. Is, we've been in a centrally planned economy, and maybe that's the way it's always been. You can make the argument, but I don't know. I think those experiences really opened my eyes to like how the system's built, and most people don't actually get to see it firsthand. It's just kind of like the water you're swimming in.
Yeah, I think one of the things I've liked about the stuff you put out there is that you distill like a big idea down into like a digestible sentence or whatever, right? Like,
Mhm.
I wrote down some tweets you had, and one was like, I'm so bearish, I'm bullish, which, that was one. But then it's always been about housing, always has been, always will be, or like the
Mhm.
idea that like it's all just like you can enter in any acronym this, any program that, but it's all just the system moving forward with the pressures, right? You guys talked about the Trump Elon breakup and all that, and it was just
Mhm.
like that was also a kind of eye opener for me was that little instance where you were just like the system literally just broke them. Like it's
Mhm.
like it obviously just happened. Like you're watching it happen right now. And stuff like that, I think is like I don't know if people put enough weight into that. So yeah, well, if any of those stand out to you that you might want to talk about, but also I wanted to give you an opportunity to like you're pretty good at ranting. So like allowing you to just maybe give your general outlook on where we're at because you tend to I think like those bigger takes, right? The societal takes or whatever. So wherever you
Yeah.
think is best to run with that, I think would be great for everybody.
Yeah, yeah. I'm bouncing around here. One experience I had, which was just eye opening, was I worked at Franklin Templeton for this guy named Ed Perks, and he ran $100 billion, and which is like one of the largest funds in the country. It's called the Franklin Income Fund, and at this fund, essentially, it's like where every baby boomer parks their money and they get this
Hmm.
a high yield on that. It's a 60/40 fund, your typical 60/40, but what he does is he shorts volatility to generate extra yield in the market. Now, what that means is you're essentially taking equities and turning them into bonds. And so, the way saw this big picture was like during 2014, 2015, I think when I was there, Ed was getting like $25 million a day in inflows. Like it's like every day for like months, boom, 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 just absolutely ramping. And I think it was just a demographic thing that was really going on. And because all these baby boomers were just like, where the hell do I park my money and just sit and just, I want dividend income and not to lose. So they're playing not to lose, right? And that whole like phenomenon was really eye opening to me. So, we would, by short volatility, it would be like, if you saw, it's probably too derivative, but normally you can judge like a stock's performance and you watch their implied vol and say it's an implied volatility of 20, and all of a sudden something weird happens and that implied volatility goes to 30, and it brings in a whole new kind of like, whether it's short covering or no whole new set of tourists into the stock.
Hmm.
And how you generate yield is you see that pop in volatility and you sell calls, right? So you
Yeah.
take in that income, and generally 95% of options expire worthless. So
Mm.
over a long period of time, you're just essentially annihilating the middle class. Is how I say it at extreme. But
Mhm.
when you short volatility, you're just putting a giant bell curve on everything, and that's largely been what our system has evolved into. Is as spreads between bid ask have dropped and dropped and dropped and dropped and dropped, you know, derivatives have grown and grown and grown because you can now do this thing called delta hedging, and the dealers become that much bigger of an influence on stocks. But also the information is so widely disseminated because of the internet and technology, where like there's not really some asymmetric knowledge you have in public markets anymore. So like everything is kind of arbed out. So the reason why I've become like a macro frontier investor in my mind is, or something that's just orthogonal to what everyone else is doing, is the system's been co-opted by this short volatility strategy. And it's largely because baby boomers have incentivized that, because they're playing not to lose now. They're in their latter, years, and they just want, guaranteed money, and not, they don't want to go out and invest in innovative things. And this is part of Peter Thiel's whole, sorry, tell me if I'm going down rabbit holes here, but
you're good.
Part of the whole problem with American society right now is we're secularly stagnant. And the way, Thiel talks about this is, he says, we used to go to London on the Concorde and in 3 hours, and now it takes 6 hours to get across the ocean. So like we've actually gone back in technological terms, in actual physical advancements, because no one's really trying to push the button. You could make this last like 20, 30 years was largely about using debt to extract value from different sections of the society, right? Like that's really what banking is, I'm just gonna, take money from the middle class and, put it in my pocket as the elite.
Yeah.
So I've basically created this framework where it's like capital versus labor is essentially what it is, but it really is short volatility. The way you control labor is you have to short volatility, meaning you actually you create so much debt that they to be on the ends of the bell curves and the frontiers, you have to really be a divergent thinker.
Yeah.
So I'm going, very, very philosophically, out there. So like the supply of those orthogonal thinkers gets smaller and smaller in a world that's completely centrally planned. And so like that's sort of why like I've went to crypto, because you do have those really divergent people that are trying to build new things, and it's kind of outside the system. And the way I think about Bitcoin specifically is it's actually pro labor. Like that's the answer to all this money printing is, the only thing that's kept up with the dilution of the currency every year has been Bitcoin and gold and stocks. So, that's the answer to everything. But all of my experiences have basically formed this whole thesis of capital versus labor, from short volatility to long volatility. So you have to be long volatility if you're our generation, because there's no way of catching up to the boomer system that's just like at every turn. As soon as the credit market sniffs, they don't want to get, they're going to bail themselves out at every turn, because like their house is where they're not working anymore. They're kind of aged out of the system. They can't afford to let this system go. So the better, alternative is to just like death by 1,000 cuts, dilute your currency, and, then the next generations end up building this whole new system that should theoretically work better for us. So that's, I think we're in this transition between the two. Is that a good enough rant? Or
yeah, it seems like to me like everything kind of comes back to being a market. So it almost seems like by structuring it this way, the sharps are just like eating the retail, shorting volatility, doing whatever, creating these products, convincing them that playing to lose is a good strategy, and that you either partake in that and become part of that game and just feed the wealth gap, the system, the better players taking advantage of the worst players in the market, or you're basically taking the anti-position of that, right? You're almost like it's almost like GME or something, where you're just trying to play the short squeeze on the system in general, if that makes sense.
And that part of the GME phenomenon is actually like a microcosm of the whole thing,
right?
Which is like, if you look at I wrote about this. I think I wrote about this when I was at Blockworks years ago. But if you look at the holder base of GME, it's Vanguard, it's BlackRock, it's State Street, and what they basically did was they basically collapsed the fee structure of investment. So there used to be a hurdle rate for investment, so that because you had to do due diligence on stocks. Now you don't. So you just like it's just a giant asset flows game now, and everyone thinks it's the same game as years ago, but it really is not. It's just based off of like your incentive to get access to the market. So GME essentially, they choke the float of GMA through passive holding. And the larger these passive players got, and the more inflows they had because like of Fed money printing, it created this phenomenon. And I think we're going to actually see more and more of this. Like this is why Michael Saylor's like strategy makes so much sense to me.
Yeah.
In the Bitcoin treasury strategies is if they actually let a free market happen, then this phenomenon would not exist. But like we're going on almost 15 years of, you know, money printing, whether it's like monetary policy or fiscal. And at every turn, you just keep increasing that because you have to pay the debt. The truth is like you have, you know, $1 trillion in interest costs on the government balance sheet. You need to finagle that so the money keeps flowing, right? And so anyway, my point is on GME is you're just going to have more and more of these kind of like weird short squeeze, gamma squeeze type situations because the market structure is really it will never reset. Passive, we're past the point of passive, the passive market actually like going into reverse now, I think. And that's a whole nother subject, but yeah, I don't know which
the Mike Green subject, right?
Yeah.
Yeah, I mean, I remember the scariest thing I ever heard from him was like the thing he said was like the scariest was that even at the worst minus 32% or whatever of COVID, it was only like Vanguard had only had like 1.5% of redemptions called in or something.
Yeah.
And he was like, what if it was 4%? You know, like because I mean it was not, I mean, I was trading futures that whole time, right? It was like my Super Bowl because I love volatility, click trading, scalping. Like that was my dream. And I was like, dude, these markets are absolutely, they're not real. Like I had been trading since 2013, right? What I saw from 2013 to 2020 was not what I saw in 2020. You know what I mean? Like I had never seen the bond market literally empty. Like, right. And for me, that was like awesome. But I was like, and now I'm hearing him say, like, well, actually, nothing even really happened to like passive flows or whatever. And I was like, Jesus Christ, because yeah. But going back to what you're saying is like, it makes sense, but you have to truly believe, like, if you're going to play the GME play against the system, you have to believe that like you're gonna win, right? Or else you just play the game that they're playing, right? Because if you look at the GME thing, you're like there was the movie, right? The Netflix documentary or whatever, and then it ended, and I'm like, yeah, but like a shit ton of people lost money. You know what I mean? Like, yeah, maybe a few donks just ended up winning some money because they didn't even know why they made their good decisions to like exit. But eventually, like what, maybe one or two funds got punished, and like the rest was retail losing an ass ton of money. So like, is it because Bitcoin you feel like is going to force the move anyway? Like there has to be a true belief that like you're going to beat the best players out there, right?
Yeah, I wasn't saying the GME specifically. Like, you know, I'm not like a GameStop believer, but just from a flow.
Yeah, I get it.
This is happening in, you know, different stocks, and you know, Bitcoin specifically is where I think it all comes home to roost because these Bitcoin treasury companies are copycatting now, and eventually, you know, if it's geopolitical and you're getting off this petrodollar recycling and going into, you know, Bitcoin or gold as an asset, you're gonna get it. And this has been the norm throughout history. The other funny thing is like what Wall Street doesn't talk about is money has always gone from public to private. Like as soon as like the public market money gets just torn to shreds, someone comes up with a private market. This has happened throughout history, like, and it's the norm. But they don't seem to think when you're in it, they don't seem to think it's happening. And one of the greatest things I tell my boomer friends is like, oh, they're Bitcoin. It's like, oh, what is this Bitcoin fake money? And I'm like, well, what did your treasury bond return the past couple of years, and it's a
Mhm.
negative return. Like you've lost money investing in your treasuries, and so they don't even realize like the relative game of all this stuff, or why most of their bond portfolios are down
Yeah.
in general, and it just debt doesn't, like, what is debt at this point? You just keep bailing out the debt markets every
Mhm.
turn. Like even like this SLR thing that's come up now.
Yeah.
It's just a way to buy more bonds, but the boomers are the ones that are going to pay the price, because
Yeah.
what happens when the millennials and Gen Z get into the political seats? They're just going to create massive infrastructure plans. Nominal growth is going to be at like 15%, and the boomers are going to be stuck in the bonds and just getting torched. And I think that's where like we get into the Weimar Germany inflationary cycle, which we're probably on some sort of cusp of. Like people keep wondering why the market never goes down, and I'm like, well, what else are you going to invest in? Like it's just where are you going to put your money in? A treasury bond with a deficit at 8%? Like it doesn't. Nothing adds up to retain your purchasing power at this point. So I don't know. I think we're at the next, the first turning zone where the only way to get out of this is you can't be a short volatility investor anymore. Like you can't just rip like a 5% yield, because inflation, sneaky inflation, like real inflation, is probably like 6 or 7%. Like everyone kind of intuitively knows this. So you're losing 1% a year, and the social contract is slowly breaking. You can see it like
Yeah.
everywhere you go. There's just it's in California. It's probably on steroids over there. It's like I don't know how. One of my favorite lines is like, how do you have like, if a teacher can't live within like a 15-minute radius of where the school
Yeah.
is, or your police force can't live in like certain cities and they have to commute 2 hours, like that's not a good thing for
Yeah.
the social contract. And these things are slowly breaking. And I don't know if this is like we'll see like a real fourth turning crack, or I think it's just going to be like a giant, rip in stocks and risk assets, and you just got to get on the bus. That's sort of where I think it's going.
That's where I've leaned towards. Like I had that written down for you because one thing like listening to your stuff is I feel like, you know, a lot of people think we're in or about to experience a fourth turning. And I'm like, Tyler always feels like he's mentioning first turning stuff. And it's almost like he's caught between a rock and a hard place, whether or not we're
Yeah.
experiencing a fourth turning or we're actually just seeing a lot of like, we pulled that forward in a way during COVID, and like, we're kind of finding our way out. So
Yeah, I
what's
think
your thought there?
so. Yeah, I am torn. I do think we're more close to building the new institutions. And if you look, I talk about Rocket Labs every freaking week on forward guidance, kind of as a joke, but also as it's breaking out to a new high today. And it's space and the frontiers are really where, and the other thing is like, what happened to when they came to America years ago? It's like you were basically forced to come to America from the other countries. Like the reason people went across the ocean and went into the frontiers is because you were forced to. Like you had no other choice. Like and those first movers end up settling the lands here, etc. But that's why like space is the next one of the next frontiers that I think we're going to have to settle. And a lot of innovation comes from traveling into space, like your new technologies. It's a very physical thing relative to like the last 15 years was, I could make the argument it was just a technological arbitrage where like the Mark Zuckerbergs of the world were just stealing growth from different sectors of the economy. I don't. Yeah, we could talk about that ad nauseum, but I think there's this transition into the real economy and like real physical breakthroughs now that we're venturing into space, and we're getting away from just this like arbitrage, like from taxis to Ubers, that type of
Right.
thing.
Yeah. Rocket Labs is currently breaking an all-time high pretty much right now. That's pretty
Yeah,
fun.
And so like I don't know. In my mind, it's like, are you going to invest in like is Campbell's soup going to be like the new innovative thing? Like what millennials like? Oh, I can really get ahead of the inflation putting my money in Campbell's. It's just not going to happen.
I
So
think I think you've pointed it out is that like um the money is showing you, right? Like the money's talking. Like you're right. No millennial is buying bonds. They're not buying Campbell's soup. They're not buying GM. Like the money is flooding into Circle. I think I literally just got a fucking notification that Circle hit
yeah,
$300 right now. Is it at
yeah,
300? It's at 295. And
it's
like
true. Yeah.
and bonds are slowly eating away at boomers who have been alive for 70 years and still don't understand like that a hurdle rate is higher, right? Or like it's
Mhm,
almost like we're watching the wealth transfer in real time.
mhm,
Problem is we want it. Like I deal with this too. Is like I've been around crypto long enough to where like if things aren't happening quickly, I start thinking they're not happening at all, right? Like
yeah.
you know, and it's sometimes I have to sit back and think about the bigger picture and be like, well, it is actually kind of playing out in the way you might kind of think. But going back to what you just said is I think it's going to accelerate um, to where there's a point where like that wealth transfer will probably like capitulate in a way where we'll get
Mhm.
rich and bonds will lose more value or boomers will actually lose some of the wealth they've gained over time. Is that at all kind of aligned with what you're thinking?
Yeah, absolutely. I used to work for this guy named Mark Hart. He's one of my mentors in the business. I think he's one of the best macro investors on the planet. He was one of the guys who he shorted subprime in 2008 with Kyle Bass. He bought Bitcoin in like 2014. He's one of the first macro investors to do that. He bought credit default swaps on euro debt in like 2010 before the European sovereign debt crisis.
Legend.
And yeah, he's kind of a legend. I mean, his big wins, super big wins, some losses, but mostly wins. And so I worked for Mark for like 4 years. And one of the things he used to bring up was, you know, just psychologically how asset values change. And he's like, back when I was growing up, China, like plates and stuff was like this investment that all
Mm,
parents were like,
yeah.
oh, you got to buy some China because it's just going to really, and then what happens is like my mom now has like, a whole armoire full of China that's worthless.
Mm,
And,
yeah.
and so,
How
because
dare you, Tyler? That is not worthless,
and
okay?
so like the value of things change like over time. And that's one of the fascinating things is in like what I'm worried about for gold. Like I love gold strategically, but like the portability of it as the demographics change
Yeah.
and people are like, more tech savvy and the on ramps to crypto are much easier and foolproof. The next generation is not going to be buying gold. Like
Yeah.
the only maybe they are if we're living in like a China centric, hegemonic world where that's what they choose as a store of value for them, which is possible. But I don't know. I think we fast forward 20 years, gold might look like the China plates that
Mhm.
like people had. So it
Watch
really
out. You
doesn't
never
make
know.
any.
Robinhood might make it cool to buy gold, right? Add some little bells
Yeah,
and whistles.
I mean, I'm not against it. Gold looks fantastic here, and really, like
Mhm.
philosophically, it makes a lot of sense as like a backing to your currency at this point. When if bonds are really people are waking up and saying, "Wait, what's a bond? Like,
Yeah.
what's a bond when you devalue your currency by 6% every year or dilute your currency?"
Yeah.
That's the fascinating thing.
It's
Um,
still pretty amazing to me how many people like because we get caught in this echo chamber of people who are kind of sharp, right? And like kind of get it. But, you know, 9 out of 10 people, if you were to say, like, does a bond make money? They'd say, yeah, like it earns like a percentage, right?
yeah, yeah,
Yeah.
or like yeah, I think the after this is what really I hate it, but it forces me to be a frontier investor. But like you have two kids, right?
Hmm.
Your daycare costs mine are more than my mortgage. Like
Yeah.
that's
Close.
wild.
Close for me. Yeah. Hmm.
It's so yeah, you live in California, so it's a little bit different. But it's just and I got 3 kids. But like that in itself, it's terrible that that's
Hmm.
what we because I would love to save money. I would love to basically park it in a bond and get a real yield. But I know that like if I'm buying a 5% yielding bond, I'm basically making 1% a year, and that's not going to keep up.
Yeah.
You know, relative to like healthcare expenses go up 15% a year or
Yeah.
whatever it is. And your car insurance, like all these other things that you have to buy are just crushing our generation. And there's only one way out. And that is they are going to come up with as many acronyms as possible and fiscal infrastructure plans. And that's it, like we saw during the tariffs, it took 2 weeks and the credit markets kind of shut off. The VIX inverted, which
Yeah.
is like the best time to buy because it's at every time the politicians have to come out and just like make the system okay because the end if it unravels like imagine the boomers trying to sell some of their bonds and their pensions.
Yeah.
It would be overnight you'd go to like zero, like you said, the Mike Green scenario.
Mhm.
If the credit markets really shut off this time, there would be no bid. So
Yeah.
it's in that we were probably a week or two away from that if Trump kept like 100% tariffs on China.
Yeah.
He knew it. Everyone knows it. So the only people are slowly getting it. It's like, okay, I have to invest in nominally grow or stuff that has real growth.
Yeah.
That's backed. It's basically, you're gonna have to invest in the AI. AI is going to be huge because it's an existential threat. Like
Mhm.
if China gets AI before we get AI, that can undermine our system. And I'm talking about AGI, which is like years out. So you have to be in these pockets, space, uranium, like nuclear power, that have like supply and demand dynamics that are just like really constrained. So that's sort of where I'm kind of looking at right now.
So how do you personally deal with like that all makes sense, right? And I'm positioned the same way. Like my whole portfolio is essentially Bitcoin, some Bitcoin proxies, maybe a little hyperliquid.
Mhm.
Allegedly, I'm a US citizen, so um
Yeah, yeah.
and then like multifamily building passive real estate. And that's literally it. Um, because like I've kind of gone through all the options of like, do I want to be in the super frontier land? Do I want to spread myself thin? Do I trust myself to kind of stay atop that? Or do I just buy Bitcoin and shut up? Do I think it's like the best vehicle to play this? But obviously
Mhm.
with that and having some money, like stomaching the swings of it with the market speed wobbles has been, I've been around this a long time and it's still difficult to deal with, right? Because like every time
Yeah,
the VIX shoots up, we're shooting up to like 30, 40, 50, 60 VIX, like that you're going to take these like 20, 30, 40% hits to your portfolio sometime that are just like wildly punch to the stomach, when you're trying to live a normal life. So
yeah.
how do you deal with that when you're investing in a lot of this stuff that's like yeah, like you think it's time to pull those triggers, but like at the same time it's like some days you'll log in and be like, God, this was fucking dumb.
Yeah, I mean, this is where that is the hardest thing
Mhm.
is actually having conviction. And I am a trader, so I probably overtrade, and I do take profits probably too soon. But I think we're if we are in this like geopolitical fourth turning, you have events like this that happen every couple months now because the system's eating itself. Like you can only centralize so much and what we really did, and this is probably a bigger history lesson, is like globalization just unlocked so much like external labor, and now the labor supply applies it went to a smaller subset of elites on the coasts. And Louis Gove has this line. He's like, I love saying this because it fucking nails it. which is, what the global coastal elites decided in the US is they wanted their Hamptons houses to be, $25 million a pop instead of, $3 million a pop. And the cost of having those, that huge inflation in their Hamptons house was they had to annihilate the middle class and outsource, the American labor. And then you basically like annihilated American manufacturing to the point where, to cover up the bruises and bumps and bruises, we gave them, an opioid crisis in middle America. And now we're left without, a manufacturing base. And now in a war scenario, we can't even we can't even build ships. We can't build a nuclear power plant because we don't have the manufacturing capacity at the same pace that China can. So these are our leaders. These are what's so funny to me. And this is probably, who our politicians are, and our system has just been absolutely co-opted. And it had good intentions at the beginning, but anything done in scale for 40 years is just fucking terrible. And now we're seeing, and our generation feels it, but we can't even get these boomers out of power because they're 80 years old and hanging on. They have to basically be forced. Dianne Feinstein was forced out, and Mitch McConnell. I'm we have nothing in common with those people, and that they shouldn't be at the helm making decisions. And that's bipartisan too. I'm just
you don't relate to Mitch.
Yeah, him mumbling and freezing up, and I'm that's comforting. Those are the people that are in charge of stuff. And but they've left us with zero kids coming out of college. Could you imagine oh, I spent 250 grand. They lent me this money to go to this insane college and come out with a liberal arts degree for AI. There's no open jobs coming out after incentivizing them to get into debt. What? Fast forward 5 years, what the hell does our system look like? It's kind of wild. If AI does not work and make everything more productive and open up new, create new industries, places, it's really scary. It's very dystopian. And I think what you do in that situation is you just keep printing money, and you just keep oh, here's
it ends up at UBI. It almost forces UBI on the world or the country.
Yeah, I think the state gets bigger and bigger until you decide on a new capital base, which theoretically would be like a Bitcoin standard. But yeah,
yeah, you're right. I mean, I think of somebody coming out of college because I live in an area where there hasn't been as much turnover. So a lot of the homes, they're 20-year-old homes, and it's the second family that's lived here. So a lot of their kids are going to college or just in college and graduating. We're the young ones, right? We had the little kids, and
yeah,
it's really
I put a tweet out about them.
What's that?
I just put a tweet on this recently.
Oh, I saw it, and I was jealous because I was I wish that we had similar age kids because they were, they'd all be playing and stuff. But
yeah,
they're all 16 and 17, so they don't play in the street anymore.
Yeah, and that's largely my buddy, he's in the East Bay in California, and he's says the same thing as you. He's the next closest kid in my neighborhood. It used to be when we were growing up, there's 40 kids playing outside, and now there's 3. And so that's what the politics has really done is, we're watching birth rates drop. That's a real thing, and debt has consequences. When your student loan debt is 200 grand and you're not procreating, and then the asset values are where they are, the imbalances are so huge. I don't get. And there's also a total underground economy of parents giving their kids money. And it's psychologically just so damning for the next generation too, because but all these things are going to have to be worked out once the political regime changes, because we're acting like it's the same. And I think that's the point of watching the frontiers is money is going to Bitcoin, and crypto's had this horrible pullback. Don't get me wrong, but Bitcoin's still at 100K. That's incredible. So
Yeah, and to your earlier point, I feel like another reason is like our neighborhood here. It's nice. So like you're not going to have young people move in and have kids. Like it's very you have to have a very specific income style, right? And those are going to be pretty heavily work focused. You know, not as much time to have as many kids. Husband and wife are working.
Yeah.
Um, Yeah, it's just interesting and it changes the whole vibe. Then it ruins like the thing I see in your tweet is like community is like the word that lacks around here. You would drive through my neighborhood and you'd be like, wow, this is a fantastic. There's, you know, there's
It's
trees
gorgeous.
and it's beautiful homes and there's pools and like you'd think, but in reality it divides everybody more. People
Yeah.
stay in their homes and I complain to my wife. I'm like, I love our neighborhood, but I don't know anybody here. Like there's no doors that are open and
Yeah. It's
plates
kind
that
of
are being
sad.
shared. Yeah, it is.
And I love California. Like, don't get me wrong. I think it's the most beautiful state in the country. But it's from a living perspective, you know, you go to get a sandwich at a deli and it's like
Yeah,
$25.
it's
It's
tough.
it's it's really it's hard. And so it's like what I say, it's like Gotham. Eventually you're gonna hit this point where that guy that's actually like working, you know, his deli and he's charging $30 a sandwich now, he's gonna get eventually people are just gonna stop paying that.
Yeah.
And then, you know, it gets less and less diverse. The artists leave. I saw this in San Francisco specifically, but like when the artists can't afford to
Mm,
live, it really it turns it into a soulless corporate private equity driven, you know, disgusting place. And
yeah,
and like there should be rules against private equity because it's just like, you know, everyone just gets depressed immediately and then some MBA from grad school comes in and tells you like you're doing things wrong and it's like because of the you know they need a EBITDA of like
yeah,
4x or whatever. Just like and then but what happens is people there's going to be more diasporas of people to like different enclaves. Like I think I was just reading something about like Amarillo, Texas or something is
mm,
like this new hub of tech innovation because like the artists move in first, they make
yeah,
it really nice and cozy. It's low cost for creating new businesses, and then you know. But so it's gonna be interesting how it shakes out. But I just don't think like the yesteryear of where like California was the thought leader in New York and California were the thought leaders of the
yeah.
country. It's almost inside out. And you can tell it in the like you watch TV, you see like Landman now and all these like
Mhm.
westerns. It's like trying to like reincarnate and
Yellowstone,
this
right?
yeah, yeah. This yeah, Taylor Sheridan type things
Mhm.
reincarnate like the American dynamism we used to have, and that's the hope. You know, that's the hope.
Yeah,
We'll get back to that once, but it goes back to my original point, which is like that's what happens when you short volatility for a generation. Is
yeah,
is you kind of just like you're just taking money from a different sector of the economy and putting it, you know, in the elite pocket rather than and a lot the last thing I want to say is just like one of the things that I find just nefarious is it hasn't been a free market like we like Bill Gurley has this line where it says the regulation favors the incumbent. And I
mhm,
love this. I think it absolutely nails it because like you used to be able to like my boss Mark Hart used to say, when I started my hedge fund, I started with 300 grand. And
mm,
I was the one like I'd invest in at the end of the day, I would calculate like the you know the numbers and do all that. And then you could actually compete. So the market was completely decentralized with market participants. And
yeah,
you had so many different incentives, and people would invest in different things, and it made your economy dynamic. And now there's so many regulations to starting a fund or an investment firm that it takes you probably need $100 million to start a hedge fund now because of all the regulation. So what it really has done is centralized power in these you know
yeah,
big long short multi-plat funds, and it kills innovation in our economy because like one of my buddies from MIT says like a really good system has like millions of different incentives at play. Like I'm trading with
yeah,
you because I like this And now what it is why we see these VIX pops really quick and then they recede, is because all these stupid hedge funds do the exact same shit and they invest in the same shit to make 5% a year. And you're like, and charge 2 and 20 to like pensions. And you're like, what the hell is that doing? Like all the incentives are to centralize rather than to, create innovation. And so maybe we'll see, I think that's why, like, there's this other line about Peter Thiel. He's like, the thing that's least in demand is courage. And like private markets are where courage happens. And crypto, I think, is where courage happens. And so I think those are the places where you're going to see the new institutions in this first turning really, really emerge. And like, you're just going to keep up with the crowd, buying the S&P, and you have to be divergent at this point. So I think that's where, the next 20 years, but it's hard, to your point. Like it's hard to hold in the because at some point that the credit markets will unravel for some like unforeseen reason. And you never know if it's this time. Like, I mean, it could have been Trump's tariffs. It could have been Iran. I don't know. It's really hard. It's hard to do.
The nothing ever happens meme until it all happens at once, right? Yeah. I mean, I remember somebody telling me a long time ago about like volatility needs like an escape hatch, right? Like it has to go somewhere, and every year it changes as to what people think that'll be. It's going to be the year that Forex goes crazy. That was I had been hearing that, and I guess that's somewhat true. Like you're seeing a lot of currencies like move quite a bit, but just it's interesting that it's even leaking out into culture. Like you're saying, like California is maybe a good example where that short volatility eating away at the core, like the system is eating away at even like the American life.
Yeah. Well, this is there's this guy Chris Cole. He runs this fund called
I know. I almost invested in his fund. Thank God didn't pull that trigger.
Yeah, well, this is what's crazy is like I'm always attracted to these like iconoclast type guys in terms of like their thoughts. And I think he wrote this paper years ago where it was like, you can't stifle volatility. If you do it, it emerges somewhere else. And like it really has emerged in the social contract. And one of the fascinating things, I think Peter Thiel's the most fascinating guy on the planet. But he said, what Starbucks did, no, it used to be when you kind of treat your employees like shit, they would always come and be like, we need to get paid more. but like instead of saying like we need to get paid more, they're like, well, you know what, you can put up LGBTQ flags and you allow them to like have all this like virtue signaling social thing. So essentially they thought like my moral code was really more important than like the money, even though you're getting absolutely annihilated by the real wages. You had this like release valve, and that was like corporate virtue signaling. And so like as long as you allowed the corporate virtue signaling, no one complained about how much money they were making. It's so like, and like not to get too political, but I think that's largely what's allowed the short volatility trade to keep going. Because like, but now we're seeing people being like, well, shit, like I need my wages to go up. And you're seeing it, especially in Japan. If you look in Japan, for a generation, their wages didn't do shit. And now they're slowly going up because the food prices are going up. And so if you see food prices rising, that's the key to when like shit really hits the fan, because people will really start like going, ape shit over when they can't pay for food. And everything else is like, whatever. But when they can't pay for food, then they start really going, that's when the credit crisis actually, I think, happens.
Ultimately, it's just the simplicity of just food going up. It's pretty crazy. It all like comes down back to like, distilling it down to a simple point. But you're right. It's like the woke kind of agenda and all that reached a fever pitch. And maybe we're, like you're saying, people are starting to remember that wages matter, and that, maybe it's all, everybody got too far into the like the virtue signaling thing, and the wealthy people are like, yeah, keep going. We're gonna
Yeah,
keep printing on the back end here. You keep doing
yeah,
your thing.
exactly,
And nobody
exactly.
realizes it, right?
Yeah,
Getting got.
it's a big it's all a psyop. Like I think
Yeah.
it's a con game and a psyop. Like if anyone woke up, you know, tomorrow and you were like, well, why would I buy a bond? Like
Yeah.
I don't like as a millennial, like why would I actually buy a bond? Why are there products buying bonds right now? If you're, you have an 8% deficit, your dollar's getting crushed. Like what we're seeing right now is global investors, like Japanese yield investors, which used to funnel, their export money right back into buying, US bonds. If you currency adjust that, you're actually going to be losing because the dollar's been falling. So I think the dollar's fallen like 10% or something
Yeah,
recently.
quite a bit.
If you buy a 5% bond as a Japanese investor, you're just going to take a hickey on it. And so that whole like capital cycle is kind of reversing here. And I don't know, the confidence game is like people really wake up and notice like what you're holding could be like an atomic bomb.
Mm-hmm.
Like you're holding most of your wealth in these assets. It's really scary. But at the end of the day, I think you just end up printing over it, or you come up with weird political things to just stifle the vol.
Yeah.
And that's just the name of the game. It's hard to hold through that though, because sometimes the politics, it takes an extreme move for the politics to change.
So the riskiest thing for them is for people to wake up to that notion, right? That's the riskiest thing of all, because you just can't have that happen, right?
Mhm.
Bring that adult into the room, old Besant, he'll talk everybody down. We trust that guy,
Yeah,
nice
trust him.
suit, glasses. He likes men, right? Like it's
Yeah.
it's perfect for the time.
Yeah.
He worked under Soros. Oh my God, legendary.
Yeah.
Perfect.
Oh man, the whole centralized. What's so funny about all these guys? Like there's this thing where it's like never put a banker in a political seat, because like bankers want globalization and money supply, and like they don't give a shit about what happens in like middle America.
Right.
Like, what they do is their product is to export more and more dollars around the country and the world, so that they can shadow bank and create more and more of them. So, and like that's what this whole stablecoin bill is really, is just
It's like a
you're
Trojan
exporting.
horse.
Yeah, you're exporting dollars around to get more, network effect of buyers of treasuries. It's like it's really simplistic, but that's really what it is. And the hope is, what the real hope is, you make the system more efficient, where the hurdle rate for your average person goes down, and then they can invest in risk forward industries to create new growth. That's the biggest problem. Is I think just everyone's been, after the financial crisis, so averse to risk, and that's what's really outperformed, is the irony of the whole thing, is because the whole idea of investment was perverted by risk adjusted returns and too much data. And how we survived as a species for thousands of years was frontier investors always the ones that moved the needle forward. And it's just funny that like you're told not to invest in that stuff now. Anyway, we talk about this ad nauseum. Is that good enough, or should we
that's good. I'll end with one question. One thing I've been thinking through for Bitcoin specifically. So I listened to the Jeff Park guy.
Yeah.
I was listening to something he did a long time ago, and he was talking about this potential short squeeze of Bitcoin, and how that could differ from like going back to like a stock short squeeze, and that there were two key differences. And I wanted to know your opinion on if this makes sense at all. But when a stock short squeezes, you have two things that are naturally gravitational to that price. One is that like big funds or whatever can do the math and be like, this is overvalued based on their earnings and what they're producing as a company, so we're going to short it. And then
Mhm.
the other thing is that the CEO or the board or whatever can decide we're going to issue
More.
raise some money at the top here and create a little bit like a pressure on there. But Bitcoin doesn't have that CEO to be able to kind of make that call. And then also it's very hard to truly like um say what the most accurate price of Bitcoin is. Like can you really argue that you know what fair value for Bitcoin is? So if there were this point where there was a short squeeze and maybe certain exchanges had a little bit less to offer and OTC desks were short to react and there was this moment this this you know, I kind of picture it because, like, as a trader, like I've seen things explode, right? I've seen calendar spreads just they inch, and then go, right? And the liquidity goes, market makers pull out of the books, and it's just off to the races. And I feel like a lot of people think it since crypto or Bitcoin's now like a $2 trillion asset that can't happen. And I'm sitting here thinking of what I've seen throughout my career and I'm starting to think to myself, like, I think that's exactly what could happen in that it goes 150, 160, 180, 200, 220, 700 for like an instant. Like, yeah, it wouldn't, like, it might not last at 700 and it could flicker back to 200 again. But like, to me, there's a possibility there. And then there's less shorts to come in there and it makes me think that there is this moment of like a step up gap in Bitcoin, which is why I'm afraid to not be exposed to it because I
Yeah.
do feel like there is something we're heading towards this thing and
Mhm.
trading in and out of it and getting cute like anyway, so that's what I've been thinking about. Like when you hear that, does that just sound at all possible, or does that sound a little bit like I'm missing something there?
No, I mean that's I'm from a derivatives. That's why I like from short volatility to long volatility is like that is the demographic arbitrage. I
Yeah.
did this like podcast like as a generational arbitrage, and that in what Saylor figured out is really a debt arbitrage and a generational arbitrage, and so more and more people are figuring it out, and I think it's this moment of and like my old boss Mark Hart, I talked to him ad nauseum, but he's like, there's usually this point where he's like in subprime when everything this it's like the common knowledge game where people know that there's a problem with the housing market, and then all of a sudden there's this day where it just bang bang everything blows up, and then things just go no bid or
Yeah.
and he's seen it multiple times. He was like, we were buying credit default swaps on European debt and we couldn't get enough of them, and they were like trading at 10 basis points or whatever the hell it was, and then they went up like 20x overnight because and then all of a sudden we would try to buy some and there would be no offers.
Yeah.
And so these are the types of like esoteric products that uh you know they act similarly to Bitcoin, and the point about not being able to issue stock is really important.
Mhm.
There's this guy, like I think his name is Eric Peters from like One River Asset Management, and he goes, Bitcoin is the most original asset ever because you can't create more supply of it. So the convexity is so huge to the upside. You know, the only thing that takes out more supply is a higher price. And but you could really create if there is a crisis in the dollar, like change happens slowly, then it happens all at once.
Mhm.
Like you could see that gamma squeeze happen in Bitcoin, and like God knows how. Like you said, I mean, it could go to $1 million. You have
Yeah.
no idea, and it's just the ramifications of it is just really kind of scary because it could change our way of life overnight.
Yeah. As a
And I don't.
Bitcoiner, you wanna see it. You just you ought to see the world burn a little bit, you
Yeah, it's scary. Like I think what having BlackRock and all these centralized entities involved in it was a control mechanism to kind of like stultify that experience because
Mhm.
like at some point, if Bitcoin really went up to 700K like overnight, that would kind of mean people are losing faith in US assets. Then we're turning into like
Maybe I don't know.
Really?
I almost feel like it could happen without that at first. Like if it organically goes to 700 or whatever, yeah. But I'm just like, I guess
Yeah.
I'm kind of talking about like a wick, for a little bit. But yeah,
Yeah.
you're right. It's starting to head towards that direction too, and yeah, it could be scary. I don't know.
But what bigger thing is like, how else are you going to be able to buy? People are going to buy California housing. Like in 10 years, when the boomers go to, I know that
I'll
maybe they
sell it.
won't sell them. Yeah, but it's like what I saw with like California housing, which was like it's still a bidding war there, like somehow.
Yeah, certain areas. Yeah.
And that just is mind-boggling. So the only way to like who can buy houses at $4 or $5 million? Like I don't know. Like I don't, unless there's so much equity built up and boomer, they're getting levered, is the only thing to me that can make up the gap is if you had this revaluation of Bitcoin or some other millennial Gen Z asset. So that like you had, and this is what I think Scott Bessent is really saying when he says, there's real big imbalances here. Like if you're a boomer and you have $7 trillion in money market funds making 5% a year, you're caking it with zero risk, and then like there's a whole like lower income that's just getting absolutely brutalized,
Yeah.
and there's no way of making up that gap. So I think what you have to do is secretly what he's saying is like you have to create a bull market for like in 2000 tech bubble. That was the boomers like real like wealth grab, and I think that's what crypto is. I think that's kind of what we're getting at, but we'll see.
We'll see.
Yeah.
Stay tuned to find out, I guess, right? Yeah. So.
Yeah, man.
Well, Tyler, I appreciate the time. I got a lot to I'll rewatch this and think more about things, and I'll wonder myself if we're turning the corner. I've turned into an optimist. I was a futures trader who loved seeing the markets go down because that meant volatility would go up, but I retired. So now I just want markets to go up. I'm different now. I'm a bull now.
There you go. Yeah, be the bull on the frontiers. We got to create real growth for our kids,
That's
new
right.
industries.
That's right.
So, yeah.
All right. Anything left you want to say? I assume everybody can follow you and easy to find on Twitter, and anything you got coming up?
Not much. I'm going to be starting a new gig with Carson Block, who's a famous short seller. He's doing a lot of interesting things over at his firm called Muddy Waters. So that's the next adventure for me come September.
So we're gonna have the short alpha coming from you, huh?
Yeah, that too. But
I'm becoming a bear. Or a bull. You're becoming a bear. Yeah.
Well, bear on certain things. This is where it's interesting. Is like if you really get into a Weimar Germany type scenario, there's winners and losers, and like that's gonna crush passive management. So we'll find out.
What's the best short then? When all things go to Weimar, what's the best short out there?
Oh, geez.
Bonds. Just
yeah. Obviously bonds, but like they might just peg bonds to so they'll make it political. They can't sell bonds. Like they'll do something like that. But yeah, anything that's has a high input to commodities probably is screwed at that point. We'll find out. The big tech companies would really get dinged too. I think with a high cost of capital on the commodity side. It's kind of an inverse, especially since capital is consolidated in large cap tech.
Right. Yeah, that makes sense.
Yeah.
All right. You heard it here first. Short everything tech. No, I'm just kidding. All right.
All right, fellas. See you.
All right. See you later. Thanks, Tyler. It was good.
Yeah. It was you can cut out